Hello and welcome to this week's market call.
Latest news.
Starting first with some latest news. On the tariff side of things, last week a US court ruled that Trump had exceeded his authority and ordered an immediate block on the reciprocal tariffs announced during Liberation Day. However, the decision so far has been temporarily reversed by a different court when an appeal was filed. Furthermore, Trump has called out China on social media, suggesting that they had broken the commercial truce in this, let's say, tariff war, tariff deal that is currently happening, which of course did cause a sell-off in the last few hours of Friday evening, especially on equity markets. Last but not least, President Trump announced a doubling of steel and aluminium tariffs from a level of 25% to 50% starting on Wednesday. Moving ahead on the Ukraine-Russia side, one of the most successful counteroffensives by Ukraine was carried out over the weekend with drone strikes on Russian bomber fleet. This, of course, does not give a good signal in terms of a potential peace deal or ceasefire between Ukraine and Russia, although today peace talks are being scheduled in Turkey given these recent re-escalations, and there is a hope of a potential peace deal or ceasefire, although it is unlikely that this meeting will yield any positive results.
Crude oil and LPG.
Looking at crude oil price evolution, both WTI and Brent decreased week on week. When focusing on 2026, for example, prices decreased by around 2.5% each. First off, on the lack of a ceasefire or peace deal and escalation of the Ukraine and Russia conflict, there is the possibility of more sanctions being input on, for example, Russian energy, such as Russian oil, which of course would be a risk, a bullish risk in the short term. Furthermore, Iran has ramped up their enriched uranium stockpiles, according to the International Atomic Energy Agency. And here the question is, will a nuclear deal be struck between Iran and the US? There are still talks ongoing, and potentially will these talks yield a reduction in Iranian oil sanctions, which of course would be a bearish impact on the market as more oil supply or global oil supply would increase. Another bearish factor has been that OPEC Plus has decided to increase the amount of supply for the third month in a row. So in July, a further oil output hike is expected. And furthermore, the current tariff situation, again, the kind of deterioration in US and China relations and the increased steel and aluminum tariffs do cause further uncertainty and again, are another reason for the decreases we saw last week.
Natural gas.
Looking ahead at the TTF price evolution, we saw decreases across the board. When focusing on calendar 26, for example, we saw decreases of 5.4%. When we look again the past week, we clearly see some decreases, and even in the past 12 weeks, especially for the close quarter products of Q3 25 and Q4 25, we do see decreases of around 10% depending on the index. However, when we look at the previous month, we do overall see price increases. Looking at storage inventory levels, we are now exactly online or in par with the 2022 levels. And of course, throughout the next few months during summer, we will need to increase the storage levels quite substantially. Looking at the gas storage excess/deficit between last year, clearly we are still at below the 20% level. So the spread between this year's gas storage levels and last year's is over 20%. There was a rebound in the previous month, although now this rebound has somewhat subdued. And here, if we look at the net storage injections at the moment, after some decreases, we did see a further rebound there in the previous week, meaning there were stronger net injections than in previous weeks. And the main reason for this can be found in the total supply graph on the left-hand side, where we do see a slight uptick in total supply, and actually we keep seeing a deterioration in total gas demand in the graph on the right. Focusing on the total supply, in previous weeks we did mention that there were several outages in Norwegian gas fields, mainly a few that were planned, a few that were unplanned, and there were a few delays that caused prices to increase. And we can clearly see these outages impacted Norwegian gas flows there on the right-hand side. However, we have seen a further increase, although we're still not at the usual level of around 330 to 340 million cubic meters per day, but rather slightly below the 300 million cubic meter per day mark. Another very important source of European gas, of course, are LNG deliveries. The share delivered to Europe is decreasing, which is in line with previous years as we're heading into the summer months and where gas demand is relatively lower. However, we do need to, I would say, be careful, especially competing against Asia, as of course we will require some strong LNG supplies throughout the summer in order to increase our quite low gas storage levels.
Coal.
Moving along to the coal price evolution, looking at all indexes and products, we did see overall decreases from anywhere between 1.8% to 4.6% across the board. A few bearish price drivers are that the Chinese coal production continues to remain high, and European and Asian stockpiles are plentiful at the moment and keep being plentiful. Furthermore, Colombia and South Africa, very important exporters of coal, have observed increases in their exports in the previous weeks. And of course, we do keep seeing sluggish demand on the European side, as year on year we keep seeing lower and lower coal demand as renewable energy increases. And also on the Asian side, where, for example, poor macroeconomic data coming out of China, for example, has caused sluggish demand to continue and weigh on coal prices. On the bullish side, we keep seeing week on week lowering in ARA stocks, so in European coal stocks, although again, this can be mainly attributed to lower imports due to lower demand or sluggish demand. And furthermore, we are seeing a short-term disruption in Australian coal supply due to weather-related factors, although this is not expected to continue in the long term.
EU and UK emission allowances.
Moving ahead with emission allowance prices, both products last week decreased by 1.6% and 0.8% respectively for the mid-December 25 product. Again, on the UKA front, in the past 12 weeks, we clearly see very strong increases due to the potential linkage that we've explained in previous sessions between the EU and UK carbon markets. There is, of course, the risk in the short term or in the next few months of increased cooling demand. And if renewable energy, namely solar generation, is not there to take charge of that generation, of that cooling demand, more generation will have to come from fossil fuels, and therefore carbon allowance demand will increase. However, on the bearish side, better wind generation is expected in the short term, and we have been seeing wind generation increase quite substantially recently, which we'll see in the next few slides. Looking at EUA's future investment fund positions, we keep seeing a very slow but steady rebound, and therefore we keep seeing a net long position. But when looking at UKA futures investment fund positions, after continued strong increases, we have finally seen a slight retraction, although net long positions remain plentiful.
Electricity.
And now moving ahead with the price evolution for power markets, we see a very similar trend as for gas price evolutions, with calendar 26 product for Germany decreasing 3.69% there. If we look at other price evolutions, other countries' price evolutions, we see a similar trend with decreases last week. And on the right-hand side, looking at Nordic price evolution, it is quite clear the rebound that Nordic prices have seen in the past few weeks. Although again, there, depending on which EPAD you're focusing on, we did see slight retractions, such as the Denmark benchmark prices. Looking at nuclear generation on the left-hand side, although we do see overall low nuclear generation year on year, this is mainly due to the closures of several nuclear facilities in many countries, European countries, such as Germany, Belgium, for example. However, French nuclear generation, which of course remains the most important country in terms of nuclear generation, has also seen some reduction in their nuclear generation in the short term, although in Q1 25 we can clearly see generation being above previous years. Looking at renewable energy generation, we have seen an uptick lately, which has caused fossil fuel generation to lower. And the main reason for this has been stronger wind and solar generation, as you can see at the bottom there. And finally, looking at hydro reservoir levels, although Norway and Sweden did have, or the Nordics did have, excess hydro reservoir levels, we are slowly seeing this excess decrease, and we do expect it to become a deficit due to lower precipitation forecasts and low snow cover. And finally, looking at guarantees of origin price evolution, we did see a decrease overall last week, mainly due to the increased wind generation that we saw in the previous week. Thank you very much, and we wish you all a great week ahead.